From time to time, when I meet with prospective clients to talk about their retirement planning, they come along with some spreadsheets they've put together, and often they're very impressive and very complicated. But usually they've made one critical error. I'm Andrew Neligan. I help my clients plan for and live their ideal retirement without money worries. And in this video, I'm going to explain what that one critical error is. You see, what they do is when they plan for the future, they make some investment assumptions about the returns they're going to get on their pensions, ISAs, other investments, which is great. But they use a fixed return per annum. And that can be a big mistake because it can throw the numbers out quite considerably. So in this video, I'm going to show you why that is a problem and how that can be adjusted to make more accurate return assumptions to give you a better forecast about the future of your money. What I've put together here is a simple spreadsheet, and some of the ones I see are much more complicated than this with lots of columns and tabs. But all it's showing is an assumed starting pension value of £250,000. And we're saying, well, we'll see what the investment growth rate would be over the long term, what that £250,000 will grow to based on different investment returns. So we've got 3% per annum, 5% per annum, and 7% per annum. And you can see as you look down over 20 years, if we say that's someone's planning to a retirement of around 20 years, hopefully be longer, you can see how the 250,000 grows with those different average annual growth rates. And here you can see it projected on the graph. So as you'd expect, a 7% per annum growth rate gives you a much bigger pot, over £900,000 over 20 years, compared to one with a lower growth rate, 3% of just under £440,000. So the first message there is you can see how different levels of investment risk can make a huge difference on the compounding effect of your pension or investment over time. So the first mistake that people make is to forget inflation, the effect of inflation on the purchasing power of their money, and also the effect of charges, because it's not impossible to invest without paying any charges. Obviously, the lower charges you pay, the better, because you keep more of the return, but you need to factor that in. But what it doesn't show, and the main thing it doesn't show, is how those returns are made up, because all we're looking at here is average returns. And it doesn't mean, even though you might be getting an average return over time of 3, 5, or 7%, that doesn't mean on a year by year basis that's the actual return you're getting. Because as we know with investing, and I'll share a video that you can watch after this, and we know with investing, the actual variations of those returns is very significant, particularly when you want to get higher long-term returns. You have to accept higher levels of risk, and that means volatility, and that means the variation returns on a year by year basis. Some years you might get double-digit positive returns, and some years you might get double-digit negative returns. So it doesn't mean that you're going to get the average, and it's that variation, that distribution of returns, that has a huge difference on the growth rate, on the how your pension will grow and what it will grow to over the long term, particularly when you're putting money into the pension in the accumulation years, or taking money out of pension when you've retired. Now this, what I've shown here in this spreadsheet, is just keeping it simple. It's assuming no money in or no money out. But there's something called sequencing risk, which is particularly important in retirement when you're drawing money down, because if you start to draw money down and it coincides with a poor year for investment markets, we have negative growth, you're compounding that loss by taking money out at the same time as the value of the pension is falling with the markets, and it takes much longer, it's much harder to get back to the starting level if you have a poor starting point. So it's that sequence of returns can be really important. So what I'm going to do now is take you into some financial planning software that I use just to demonstrate how that variation of return will have a considerable bearing on the potential value of your pension fund or ISAs investments over time. Here we are there in the planning software. We want to make it a like-for-like comparison. We've kept it simple as well. So we've got a pension fund here of 250,000. I've assumed the test client here is 55, but it doesn't really matter. What we want to see is what the growth rate is over the comparative 20-year period. And what I've also done is if we look at a timeline here, now this looks at the forecast timeline if someone lives to age 100, but to compare it with a spreadsheet, we're just going to look at the figures over 20 years. And because my point is that we don't get to an average single figure rate of return, say 3, 5, or 7% in the investment markets, the returns are different every year. They just happen to average out over a particular figure when you divide by this relevant number of years. I'm showing here what the effects of market variation, so market events, has on the long-term growth of your pension or your investment fund. So I've got two events here, 10 years apart. Now, if we were doing it live for a client, we'd have stock market events every 10 years through their timeline. But to keep it simple, just two events. And what I've done is mirrored what happened to the stock markets during a period of 2000 to 2003 when we had the tech bubble bursting, 9/11, and then we had the Second World War. So there's a lot of uncertainty in the world, geopolitical and economic uncertainty, which meant the stock markets had some big falls and then some recoveries. So I just want to show you what that effect has at different risk levels over a 20-year period. And you can see how the difference is, or see what the difference is when you compare it to a simple spreadsheet that looks at just fixed rate returns of 3, 5, or 7%. So at the moment, I'm looking at someone who would be a low risk investor. So that would be the return equivalent to around 3% per annum. So if we now go to look at the assets of this person, so what you can see is we still have that growth trajectory upwards. Again, I'm not assuming there's any contributions going in or money coming out. There's just straight growth. You can see here we've got these little dips here and then steps up. And so this is where I'm modeling the effect of those stock market crashes and recoveries. So if I go into it, you can see rather than getting that 3% return, we're getting a risk adjusted loss because there was a stock market crash when a tech bubble burst. And now if I go on a year, I just have to move my picture there. You can see then we had a second year of losses and then we had a recovery. But because this is a lower risk investor, the effects of those losses and recoveries aren't as pronounced as you'll see later when we look at the higher risk levels. So that means when we're looking at the equivalent growth rate, we're looking at around £446,000. So you can see it's not that different to what we'd previously modelled, but it's still different. And it's not as pronounced because the variations return isn't great. But the other thing I want to show you, which I mentioned at the start of the video, is the other thing people don't think about is the effect of inflation. So we need to see what the purchasing power of our money is in the future by looking at it in today's terms, so looking in today's pounds. And you can see if we just remember here, we've got 75, 446,000. When we allow for inflation, and for inflation, for my assumptions, I'm using a 3% per annum inflation growth rate at 75, you can see how much it falls. So the purchasing power of our money falls significantly over time when we allow for inflation. And that's a really important thing to be aware of when you're planning your retirement and wondering how much money you need. You have to think that your costs are going up each year, and therefore you need to make sure your invested assets, your pensions and your investments will be big enough to support that inflation increasing. So now let's look at it at slightly higher risk level, someone who's more balanced, expecting around a 5% per annum return. And we can see what difference that makes. So click across to that. We'll work on future prices, so not allowing inflation for now. Now, if I go back into the individual years here, you can see because someone's taking a higher level of risk to get higher returns, the losses are more pronounced getting over double-digit returns. Then when we have a recovery, because they've got more invested in the stock markets expecting higher returns, the recovery is that much greater. So now when we look at what is happening at 75, you can see that the pension fund is obviously that much bigger when compared to someone of a low risk profile. Interestingly, when we compare it to what the spreadsheet was, which was about 632,000, you can see there's a significant difference there and a loss because the effect of those larger stock market losses, particularly in the early years, they're not getting that same growth rate when you're just looking at fixed rate 5% per annum. And then again, allowing for the effect of inflation, you can see what a significant effect that has on the real terms value of our money. And finally, just to finish it off, if we look at someone with a higher risk investor wanting to get around 7% or needing to get around 7% per annum return, perhaps. Now, when we look at their individual year rates of return, allowing for that extra level of risk, you can see around 16% potentially, around 22%, because they've got much more in the stock markets. When they fall, the falls will be more pronounced. But equally, when you look at the recovery, now we had a strong recovery in the year after, in the 3-year period when we had this tech bubble burst in 9/11 and the Second Iraq War, the markets quickly recovered. So they're getting that benefit, that trade-off. So now if we look at it again without inflation to start off with, when we looked at the spreadsheet, it was about 900,000, just over, but we're still looking at a significant difference, around 650,000 compared to that 900,000. And now for future prices, when we look at the effect of inflation again, you can see significant erosion in the purchasing power because of the effect of inflation. So the message, number of messages. Firstly, we don't know what the future of the markets will be. It could be, the losses could be greater than I'm showing here. The coverage could be much greater. It's really important you allow for the effect of inflation. And if you're doing your financial planning on a spreadsheet, you have to be aware that you might be over exaggerating the effect of the returns that you're using because you're not getting that stock market variability. I hope you liked this video. If you did, please click on the thumbs up button. If you've got views, opinions, experiences that you want to share, please do leave them in the comments section. If you want to receive more videos like this as and when I produce them, please do subscribe. And if you want to know more about how I help my clients plan and live their ideal retirement free of money worries, please go to neliganfinancial.co.uk. In the meantime, thanks for watching.